Hello, everyone. Thank you, SAFE, for organizing this conference and for inviting us to share our research. My name is Rajiv Sharma, and I will be presenting a paper which is a joint work with Esen Onur and David Reiffen, my colleagues in the Office of the Chief Economist at the US Commodity Futures Trading Commission, CFTC. Esen and Dave are also attending this session, and we'll be happy to take any questions after the presentation. I will start with a disclaimer that while this paper was produced in our official capacity, and while the CFTC seal is reproduced on this presentation, the analyses and conclusions expressed here are those of the authors and do not necessarily reflect the views of other Commission staff, the Office of the Chief Economist, or the Commission. As many of you know, after the financial crisis of 2007 and 8, regulators around the world enacted a series of regulations for the global derivatives market. For example, central clearing was mandated for certain over-the-counter swaps. And for many of the instruments that were not subject to the mandatory clearing, there were some other regulations that changed the incentives to centrally clear. One such global rule that we will discuss today is the Uncleared Margin Rule, or UMR. In US, UMR was implemented by CFTC as mandated by the Dodd-Frank Act. This rule mandated that margin need to be posted for certain uncleared swaps. Now, what do we mean by margins and uncleared swaps? For the benefit of everyone, I will briefly go over them in the next slides. And in this study, we study the impact of UMR in FX swaps market, or the currency derivatives market. In this market, we observed an increase in the clearing after UMR, but clearing is not mandated in this market. So all clearing that we observed was voluntary. Another advantage of FX market, swaps market, was that it provided us with a good control group. There is a subset of FX swaps, the physically settled FX swaps, which are exempted from the Dodd-Frank rule. Hence, the uncleared margin rules did not apply to them. So the changes brought about by the UMR in FX swaps market provided us a better way to understand clearing decisions. To understand swaps clearing, let us consider a USD Euro over-the-counter swap between trader 1 and trader 2. This trade could remain a transaction between them, that is, it can remain uncleared, as shown in this figure above the dotted line, or the traders may decide to clear the trade, as shown in the figure below the dotted line. On clearing, the original trade gets novated, that is, the trade is split into two equal and opposite trades. Clearinghouse becomes the legal counterparty for both the traders, and the original counterparty does not matter anymore. For taking this counterparty risk, the clearinghouses require that both traders post collateral to guarantee the performance. The collateral posted by traders is called the swaps margin. The amount of margin is determined by the clearinghouse for a cleared trade. But then what about the uncleared trade? Do they also need any margin? Well, after the UMR, but before the uncleared margin rules were implemented, traders had the flexibility to decide the amount of margin, and some chose zero margins. But after the UMR, the uncleared margin rules, a minimum amount of margin is mandated for the uncleared swaps that are covered by the rule. So this changes the cost of keeping the trade uncleared because it sets a floor to the margin. And there are other costs to clear a trade. For example, to avail the clearing services, the trader has to be a registered member of the clearinghouse, and if not, then the trader needs to route its trade through a clearing member by paying a fee. Let's look at some of the clearing has a lot of advantages, but in this paper we'll focus on the netting benefit that comes from clearing. To understand that, let's suppose the trader 1 has a portfolio of derivative positions with traders 2, 3, and 4, where trader 1 has a portfolio which is in net long 100 with trader 1, short 30 with trader 3, and short 20 with trader 4. Now, based on the requirements of UMR, if the traders decide, if the trades remain uncleared, then trader 1 needs to post separate margin for all of its 3 different positions. That is separate margin for long 100, short 30, and short 20 portfolios. However, if all the traders decide to clear all their trades, then as shown in the figure below the dotted line, the trader 1 is now facing just one counterparty, that is the clearinghouse, for all its positions. And after netting, it has a net portfolio which is long 50. So you can appreciate the potential reduction in aggregate portfolio notional when counterparties are consolidated to the clearinghouse. And since the required margin is calculated not based on an individual trade, but rather based on the net portfolio size, this netting of aggregate positions on clearing can result in lower margins where it provides netting benefit. Now, this is an important advantage of clearing that we want to focus in our paper. A little bit about the rule. The uncleared margin rule could potentially be, the uncleared margin rule impacts the uncleared swaps market, and the size of which is estimated to be roughly 200 trillion in notional as per BIS. The first phase of this rule was implemented in US, Canada, and Japan on September 1st, 2016. And the implementation dates in EU, European Union, and other jurisdictions are shown here. In today's presentation, we will focus on phase 1 of UMR implementation in US, that is September 1st, 2016. Just for information, the phase 5 of this rule will be coming into effect next week, starting September 1st. And we are working on an updated version of this paper that covers the later phases of implementation. The phases are defined based on the threshold of aggregate notional amount of a parent company. That is, if a parent company has aggregate swaps notional above the threshold of phase 1, we label that parent as a covered parent company, or CPC. And then all entities within that CPC, that is all its subsidiaries, will be subject to the uncleared margin rules. In subsequent phases after phase 1, the threshold amount gets lower, and thereby more and more entities get covered by the rule. So with this institutional background, let me begin by providing an overview of our paper in a nutshell. So what we did was, in a diff and diff setting, we first analyzed the increase in voluntary clearing post UMR in the forward and in the FX non-deliverable forwards market. This was the market which saw an increase in the clearing rates after UMR versus a control group of FX forwards that were not subject to the UMR, as I explained earlier. Then we analyzed the NDF panel data using the rich regulatory data that we receive to better understand the determinants of clearing decisions. We make use of this natural nudge of UMR to understand the clearing behavior, and we find that there are fixed and marginal costs to clearing. There are significant fixed costs of becoming a clearing member. For example, the fixed costs are like setting up the cost for setting up the infrastructure with the clearinghouse, or capital contributions that need to be made to the default fund, the cost of regulatory compliance requirements, etc. So there are a bunch of fixed costs. But once these fixed costs are invested in, it allows the members to then have a much lower marginal cost of clearing. The benefits of central counterparty netting is a good reason to centrally clear, as we saw earlier. But this benefit is availed almost exclusively by entities who have already paid the upfront cost of becoming clearing members. we attempt to address the following research questions, starting with the obvious one. Did the uncleared margin rule have any impact on the voluntary clearing decisions? And in a definitive setting, we show that yes, UMR did incentivize clearing. Next, we looked at the target group and asked, did all entities started clearing their trades, or did different entities make different clearing decisions? And we found that within the target group, the entities that were not covered by phase 1 of the rule did not clear much. Only the entities covered by the rule started voluntarily clearing some of their trades. Then we further narrowed down to the entities that are covered by the rule to see if all entities within a covered parent company, that is all of its subsidiaries that trade in this market, did they increase their clearing rates? And we show that clearing is almost exclusively done by subsidiaries that have already invested in the fixed cost of becoming clearing members. So it implies that there is fixed cost of clearing. And lastly, we ask that for these clearing members, have they started clearing all of their trades? And the answer is no. A trade is more likely to be cleared if it provides netting benefits. And this research we did leverages and contributes to a number of good studies, some of which are listed here. Mankweld and Villemay have an excellent paper on economics of central clearing. Belia et al. Have a SAFE working paper, which analyzes the clearing in single name sovereign CDS market. And it is quite close to what we are doing here in FX swaps market. There are some other papers listed here, but in the interest of time, I would skip, and I would encourage you to refer to our paper for the complete list. So let me move on to talking about the regulatory data that I mentioned earlier. So CFTC, we are a financial regulator, and we collect a lot of data for swaps that come under our jurisdiction. For this research, we used FX, NDFs, and forward transactions data for a 3 months period before and 3 months period after the phase 1 UMR implementation date, which was September 1st, 2016. In our data, we can identify the counterparties using the legal entity identifier, LEI, and we use external services to identify covered parent companies, which gives us a list of all the entities that were covered by the rule. And then from that list, to identify the clearing members, we use a separate in-house regulatory data that comes directly to us from the clearing houses. In terms of coverage, the NDF market under CFTC's jurisdiction is about 56% of the global FX NDF market. This estimate is based on the comparison with the global estimates provided by the BIS in their triennial OTC survey. So as you can see, it is a decent sample size for research. We limited our analysis to 14 currency pairs, all of them with USD on one side. The currency pairs were selected because when the phase 1 of the rule was implemented, clearing was available for these currency pairs at the London Clearing House, which is one of the clearing houses under CFTC's jurisdiction. Panel A on top provides the numbers of trade observations in our sample, and panel B has the corresponding notional value of these trades in trillions of dollars, USD. Numbers on the left are for the 3-month period before the margin rule was implemented, and the numbers on the right are for the 3 months period after the implementation date. And in total, you see there are more than 800,000 observations in both before and after sample. So that's a good number of transactions. It's a deep market with a lot of trades. But from the last line, which is the cleared, as you see, the number of cleared trades was 23,000 in the before sample and it increased to 90,000 in the after the implementation date, which is almost a four-fold increase. It's a big jump. While the overall size of the market did not change that much. And in terms of dollar amounts, correspondingly, you see a similar jump in the notional as the last row in panel B. In panel C at the bottom, we use the identity of each trader to summarize that in total, phase 1 of the rule covered 20 covered parent companies. These are generally the big financial houses with multiple subsidiaries. And within these 20 covered parent companies, there were 545 different legal entities belonging to these 20 parent companies that traded in the NDF market in our sample period, during our sample period. And of these 545 covered entities, 17 were registered clearing members of the London Clearing House. For our first result, we looked at the ratio of swaps that cleared around the UMR implementation date for our target group of NDF, non-deliverable forwards, versus the control group of forwards, which were exempt from the UMR. Now, each dot here represents the average daily clearing rate for all trades, and the solid line is a smoothing function applied to them. As you can see, the NDFs represented by the blue line saw a spike in the clearing rate after the implementation date, which is the red line here. Whereas for the similar FX forwards, which were exempt from the UMR, the clearing rate remained flat, almost close to zero. It's positive, but very close to zero, as represented by this red line parallel to the x-axis. This suggests that other than UMR, nothing big changed in the FX derivatives market around that time to drive the clearing ratios higher for NDFs. We take that figure and we run a different diff regression, trying to put numbers behind the jump we saw in clearing. Our control group is forwards. As highlighted in the UMR NDF interactive term, this interactive term is positive and significant. So there is definitely an increase in clearing in NDF compared to forwards after the UMR. Another thing is we saw a little bit of trend. Like as you see here, the clearing starts small but keeps increasing with time. So though this trend is small, we see that the coefficient is positive and significant. So what does it mean is that the clearing rate increases as the time goes by. To put it in numbers, what we did was we looked at day 45, which is the midway of our 90-day sample post UMR. Remember, we looked at 3 months period before and after the implementation date. So 45 is in the middle of that post UMR sample. At day 45, the probability of an NDF trade being cleared is 0.4% higher compared to a forward trade. Now, which might look small, but compared to the day 0, which is the implementation date, this represents a 36% jump in clearing probability since the implementation date. So it's saying that what we see is that the traders are more likely to clear as time goes on. We don't have a very good answer for that, but this is our observation. Looking at all the entities from the data, we observed that it was the entities covered by the uncleared margin rule that did most of the clearing. Entities that were not covered by the uncleared margin rule did not clear much. So now we focus on the NDF trades done by the entities which are covered by the rule to see how they are impacted. We see a little bit of clearing even before the implementation date. So again, this red line is the implementation date. And we see to the left of it, this black line shows that there is some clearing going on before the implementation date. And if we extrapolate that line and after the implementation date, we get a hypothetical clearing rate if the UMR had not come into effect, which is shown as a solid black line. And the blue line is the actual observed clearing rate that was observed after the implementation date. So on the implementation date, there was a jump in the intercept, and the clearing rate keeps trending up, reaching almost 40%, which shows that the covered entities are definitely making decisions to clear more after the unclaimed margin rule. Now, because the increase in clearing before the implementation is so obvious, we are not sure if the diff analysis would be suitable for this case because the parallel trend assumptions does not hold. So what we did instead for the covered entities, we looked at what is the probability of clearing after UMR. These are the marginal effects from probit regression with some fixed effects. So no matter whichever way we set up the specification, UMR comes in significant and is roughly 6% as is highlighted, which means that for the covered entities, probability of clearing goes up by around 6% after UMR. Next, we looked at the different subsidiaries of a covered parent to find out which entities of a covered parent company clear more. Now, the rule applies to all the entities within the parent company, but within a company, there is heterogeneity in clearing cost for different subsidiaries. Specifically, covered entities that are clearing members have access to lower cost clearing, but becoming a clearing member is costly. So there's a trade-off in whether to become a clearing member or not. We saw in the previous slide that of the 575 covered entities in our sample, only 17 were clearing members. And during our sample period, we observed that almost all clearing was done by the clearing members. All the clear trades were done by the clearing members. We also find evidence that clearing members represent a higher percentage of covered parent companies' trades after the rule change, suggesting that more trades flow through the clearing member. We look at the clearing decisions made by the clearing members. Clearing members could be doing the trade with another clearing member or a non-clearing member. So looking at the results from the probit regression with various specifications, we noticed that coefficient for 1 CM, where only one counterparty is a clearing member, is about 1%. But having both parties as a CM has a substantial effect on the likelihood of clearing. A 57 percentage point increase, as highlighted in column 3 when not accounting for the fixed effects. Now, this sets our paper a little bit apart from Belia et al. Paper mentioned in the literature. So the main takeaways, we see that having two clearing member counterparties to a trade increases the probability of clearing by 57% after UMR. But even then, clearing members do not clear 100% of their trades when trading with other clearing members, and they chose to post margin for their unclear trades. To find out why that is the case, we look at the netting benefit, which is the last result I will present and then conclude. So we define an indicator variable called benefit for each trade to indicate whether clearing that trade will provide netting benefit or not, based on our assumptions. Now, how exactly the netting works across the different currency pairs is a secret sauce, I would say, of clearing houses, and we do not have clear visibility into it. But we did our best by constructing the portfolio of each clearing member and used assumptions about currency pair nettings. And what we find is that this benefit variable is positive and significant, as you can see highlighted in these regression results. This suggests that the covered clearing members are more likely to clear a trade if clearing provides netting benefit. Now, since more netting means lower margin is required compared to the margin which would be required if the trade had remained uncleared. So netting is an important factor in deciding to clear. And with that, I'll conclude by saying that we show that after the UMR, voluntary clearing rates for FX NDFs increased overall, as well as in comparison to the control group. So our findings are relevant not just to the FX swaps, but may be applicable for uncleared swaps in all asset classes. Increase in clearing was almost entirely due to entities covered by the rule. unclear margin rule. And within covered entities, the likelihood of clearing a trade increases considerably when both counterparties are clearing members. However, we argue that there are some fixed costs to becoming a clearing member. And even for trades between clearing members, likelihood of clearing a trade is higher if it brings netting benefits. So thank you for listening and for giving us this opportunity to present our research. I look forward to hearing your valuable feedback. Thank you.
Thanks a lot for having me in the conference. Thanks for the organizer for organizing this wonderful event. Yeah, so this is a very interesting paper. By the way, my name is Wenqian Huang. I'm an economist at the BIS. Yeah, the usual disclaimer applies that these views are all mine and not necessarily of the BIS. So this paper studied the impact of margin requirements on voluntary clearing. More specifically, it studied one the very specific policy measure, that is the phase-in of the unclear margin rule, and how this unclear margin rule, the UMR, affects the clearing decisions of the traders. And I think Rajiv has done a great job in introducing this rule. So basically, since September 2016, the UMR imposes a minimum margin requirement for unclear swaps between entities who are part of this covered parent companies, the CPC. And although this UMR applies to most of the swaps, FX swaps and forwards are exempted. So that gives rise to this nice variation that the authors exploit in the empirical analysis. More specifically, this rule is implemented in several phases. The phase 1 covers these large firms whose daily average notional are more than 3 trillion. And then the other phases, they covered medium and smaller firms one by one. So I think currently we are in phase 5. As the author mentioned, this rule basically raises the cost of unclear trades because in some cases for unclear trades, they can charge very low margin, very low initial margin, or even without the initial margin requirement. So by imposing a minimum margin requirement for the unclear swaps, this policy also makes central clearing more attractive or less unattractive. And the paper used very granular data and exploit the variations at the trade level. So there are 3 key findings. I think Rajiv has done a very good job in presenting them, but just to summarize it for all of us, the first one is that the authors find that the clearing rate of NDF increased by 36% after the phase 1 of UMR compared to that of the FX swap and the forwards which are exempted from the UMR. And the second finding is that within NDF, the likelihood of central clearing increased by more than 50% when both traders are already clearing members. So this is very interesting observation that also give rise to some policy implications that I will detail a bit later. And then the third finding is that for NDF trades between the clearing members, the likelihood of central clearing increased by 3.5% if a trade increased the netting benefits for both of the clearing members. So as I said, the paper studies a very interesting policy measure, and it's actually also a very insightful, also use some very insightful implications. So the first thing is that the non-clearing members, they rarely clear their NDF trades. This suggests that the cost of being a clearing member probably overwhelmed the margin benefits of clearing. So this really points to the incentives of clearing. So essentially, it's a cost-benefit analysis. It's not only about the margin benefits of clearing, it's also about cost of being clearing member and having access to CCPs. And to some extent, some of this cost of being a clearing member probably is not completely, or the decision of being a clearing member is not completely up to individual firms, because CCPs, they have rather stringent membership requirement, especially for the large CCPs such as the LCH. And then the second policy implication is that the later phase of UMR does not seem to increase the clearing rate of NDF substantially. So this also points to what I'm about to discuss in my comments. But in general, before delving into the comments, I would like to congratulate the authors that they have done a very careful and clear, in-depth analysis on the effect of UMR on the traders' clearing decisions. So my comments are really here to help the authors to extend the link of reasoning a little bit more, and then to try to see whether we can use the data to extract more, even more information. So I have two main comments. The first one is about liquidity. We all know that in OTC derivatives, liquidity cost, the bid-ask spread in particular, is a very important measure for what is a very important consideration for both the traders and also for the dealers. I think the previous paper has made a very good case about this bid-ask spread really being instrumental in OTC market. So my first comment is about whether the authors can consider the liquidity comparison in bilaterally cleared and centrally cleared markets. So in a different context, I have done some work on this clearing decisions for non-mandated contracts, so basically voluntary clearing decisions of the traders. So here in a policy piece in 2019, so we sort of show the structure and liquidity of CDS and NDFs. So of course there are two different asset classes, and here the key message we want to convey is that for non-mandated CDS, in particular the single name CDS, we see that the clearing rate is rather high compared to the NDFs, the FX forward. So in our data, based on the outstanding positions, the clearing rate of NDFs is around 4% by the end of 2019, which is very low compared to that of the non-mandated CDS. As you can see in these two, in the left-hand panel central and the left-hand panel and the central panel, you see that the red is much higher in the left-hand panel compared to that in the central panel. And one reason we sort of conclude in the piece is that for NDFs, the liquidity in the bilaterally cleared market is far, so the illiquidity measures is higher in the bilaterally clear market compared to the centrally clear market. So which you can see from this line, from this scatter plot. So basically the line is the 45-degree line, and then the x-axis is the centrally cleared market Amihood measure, and then the y-axis is the bilaterally cleared Amihood measure. And you can see the cloud of the dots basically lies below this 45-degree line, meaning that the central clear market exhibits higher illiquidity. So I think the authors, they have very detailed and super insightful data, which should allow them to exploit how the increase of clearing rate changes the liquidity in bilaterally and centrally cleared market. So here, I think it's a very interesting problem, interesting question to study the impact of UMR on the clearing decision itself. But a related question to that is that, so what? So whether the market become more liquid or the market become less liquid, or liquidity does not really change in centrally clear market. And I think studying UMR has a unique advantage because we all know that coordination among traders play an important role in improving liquidity. So given that the UMR is an announced large shock to the market participants, it could actually act as a coordination device so that the traders now simultaneously switch from bilateral clearing to central clearing. So even though if they don't, I think that is also a very interesting observation to document. So I would encourage the authors to further look into the liquidity situation in the bilaterally clear segment and the centrally clear segment. Is it the case that, like not enough traders opted for central clearing at the same time, so that the centrally clear market remained less liquid compared to the bilateral clear market? Or is it the case that, the centrally clear market actually has a better liquidity after the UMR because of this switching of the clearing members, of those traders who are already being the clearing members? My second comment is similar, but instead on the liquidity side, I'm wondering about the pricing effect of switching to central clearing. So in principle, switching from bilateral clearing to central clearing should lower the counterparty credit risk. Is that really priced in the NDF contracts? And also, for those trades that increase margin benefits, whether they are priced different from the other NDF's contracts, that is also a question. So I think, like, on the pricing side, the authors can also do something more about pricing efficiency. How does the change of market structure improves or deteriorate the pricing effect in the pricing efficiency in the central clearing market? I think that is also a very relevant and interesting question. So I will stop here and hand over back to Christian.